What was the chatter in your team, and what is your team's house view here in terms of what President Trump wanted to get done? The economic logic behind all this. What did he achieve?
Well, at least we're now back to the negotiating table. The U.S. has been quite clear, wants to focus now on non-tariff barriers in the U.S. And one of the things that Scott Bessent has said, that he wants U.S. companies to sell more into China. This is a bit reminiscent of what we saw during the first Trump administration, if you remember, with a phase one deal come in, which also ultimately focused on how much the U.S. corporate sector can sell into China. And this will likely mean that we're going to see a focus on Chinese purchase commitments, possibly for U.S. goods coming through again, something akin to the phase one deal, but also ongoing tough negotiations probably on removing barriers to U.S. companies doing business in China. Remember that U.S. companies' sales in China about $700 billion annually, much, much higher than the exports from the U.S. into China. And so China is an important market for U.S. companies. And I think the focus is now to try to actually increase those sales rather than restrict trade overall, trying to expand the runway for U.S. companies going into China.
All right, so Fred, you're talking about basically maybe, phase 1.5, right? So more corn, more soybeans, maybe more Boeings. I think the U.S. is betting, this administration is betting a lot more LNG as well. I'm curious, though, and this was the case at least a decade ago, maybe even before that, right? There had been a big push, and you probably remember this, right, by American businesses to get access to the China market for something really pretty mundane, but this is a scale issue, right? It's government supplies, right? Everything from, I don't know, staplers to paper clips. I mean, just really boring stuff like that, which back in the day was worth a lot of money for American businesses. Is that still the case? Are they still pushing for that, or do you think they're past that now?
There's still enormous opportunities here for U.S. companies. Remember that the Chinese economy is much larger today than it was even 10 years ago. And it's about services, for example. If you think about, for example, financial services, U.S. financial services companies still have a very, very small share in the Chinese market. This could be expanded quite considerably, and not least because the Chinese themselves have the ambition to develop their own financial market and capital markets in particular. So financial services certainly opportunity. But then if you go further into healthcare services, if you look at even software services, for example, there are plenty of opportunities still. How much progress we will make in 90 days, I think, is doubtful. These are very complicated matters. But what is important is that we now have a process in place whereby the two sides can sit down and talk, which we didn't necessarily have 2 weeks ago. So, yes, tough issues ahead, but there is still opportunity, I think, to expand the access of U.S. companies in China. And by the way, for the Chinese, there is an interest in bringing in U.S. companies as well, because that ultimately acts as an insurance against future disruptions to trade, because ultimately, if the U.S. corporate sector has enormous interest in China, there's less of a risk that then we got to see disruptions come through again.
You know, Fred, when you take a step back and take a look at the strategic picture, right, one of the things the U.S. wants to do, obviously, is to redress the trade imbalance, right? China, with the rest of the world, is running a $1 trillion, in excess of that, actually, more than that, $1 trillion surplus, right? About, depending how you want to count it, anywhere from 2/3 to 3/4 of that is with the U.S. So, you know, they can tinker around the edges and maybe even make significant moves. But at the end of the day, you were talking about the world's largest producer and the world's largest consumer. So in that sense, trade is, you could sort of rebalance things a bit, right? But trade is never going to be equal or fair, is it?
Well, I mean, fair, it can be fair. It doesn't mean that's equal necessarily. So the two, you know, you could have fair trade, but not necessarily equal trade. I think you hinted something broader here, Martin, and that is that tariffs themselves are not necessarily the best tool to fundamentally redress the trade imbalance. What needs to happen ultimately is domestic political, economic political changes in the respective economies. The U.S. needs to reduce its own consumption. That could be done through curbing its very large budget deficit, for example. And China will need to rev up its own consumption to start to buy its own goods it's producing. So it's rebalancing within China, it's rebalancing within the U.S., which ultimately will help to bring down the trade deficit that the U.S. runs with China. Tariffs here only take you so far. It is about these broader macroeconomic trends, and those are very tough decisions to deliver domestically. And hopefully we'll see some progress on this front as well, particularly in the budget process over the summer in the U.S. We might see some consolidation come through, but how much will really then determine how much the U.S. trade deficit is being reduced with China.